Oh, 5 seconds of what's going on, or 5 seconds of a pause of what's going on in the world?
No, we're live now. Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Here with me, we have John Lear, who I'm going to give his 5 seconds to in just a moment. He is the chief economist at Morning Consult. Also here today, Allison Schrager, my colleague at Bloomberg Opinion. She's also a senior fellow at the Manhattan Institute and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We're here today to talk CPI. It should be an interesting one, in my humble opinion. I know I always say that, but this is sort of the first month where we may perceive some of the effects of the tariff agenda. Now, this is complicated because the actual policy has been a moving target. Even the tariffs that were implemented previously, there was some expectation that we wouldn't see the full effects maybe for a couple of months. So I don't think, if it were a great report, I don't think anybody would walk away from this and say, well, no inflation impacts. No, that would be tremendously hasty. But, we finally get the opportunity to dig under the hood and see what pass-through is starting to look like. The expectation here is that your month-on-month figure for CPI seasonally adjusted will come in at a plus 0.3%. For core, same thing, plus 0.3%. Year on year, that would translate into a plus 2.4%. I just want to stop and recognize that on the face of it, that's a reasonably low number. So if you're just looking at public perception, the way that this number might be spun in the world of politics, like that wouldn't be so bad, a plus 2.4%. And then year on year, your core is expected to come in at plus 2.8%. Just one further thing, we'll be looking for things that might be affected by the tariff agenda. That could obviously be apparel, furniture, appliances, things like that. Cars, famously, although there may be some lags there. We'll see. We could also look for some offsets. There's been some softness in some parts of the services economy. So, airfares could potentially be an offset here that helps the picture. So, John, let's go over to you. What's going on with tariffs and inflation, and what do you think we could realistically take away from today's number?
There's a lot going on with tariffs and inflation. I think, I'm breathing a slight breath of relief today after yesterday's late Sunday evening's announcement of a pause with China. We're still in a world of elevated tariffs to where we were a year ago, but it doesn't feel like we're necessarily walking off a cliff. And so I think from the perspective of, businesses, it really doesn't make sense to sort of preemptively pass through expectations of higher cost onto consumers when those expectations are in fact evolving real time as all these negotiations happen. So I would expect to see relatively subdued inflation because I think businesses are just going to wait to see what that tariff picture looks like before raising prices.
Okay. Allison, you agree with John? You think maybe we won't see anything too bad in this particular month?
Yeah, I mean, it takes time. I think, we're just seeing sort of port activity slow. So, I mean, I think if anything, maybe this is an interesting test for expectations. Because in theory, if you expect higher prices, you would start raising them now. So maybe we'll see a little bit of that. It's a nice little test for that economic theory to see if that's coming. But I think John's right. There's just been a lot of uncertainty. And I think yesterday, if anything, it resolved a lot of that, yeah, we're going to have tariffs, but they probably won't be obscenely high. And I think now everyone is feeling comfortable, at least with that. But what this actually means for prices, we'll definitely, and I think, be seeing certainly in the coming months. Although even that might be tempered again by energy prices, which the Trump administration is very keen to keep low. And if anything, that might keep this inflation report low because they've been energy prices have been falling.
That's right. That's
I would
right.
just one thing. I don't know if this is going to update real time here,
Yeah.
but one
Oh,
thing.
John, let me jump in
All
here.
right, breaking
So
news.
here we go. Month on month, you get a 0.2% for headline, 0.2% for core as well. And so year on year, that translates into a 2.3% and core 2.8%. And so on the face of it, good number. As you were, John, but please incorporate
No,
into
this
your
is.
response what we're seeing on the screen here.
I mean, Alex was talking about sort of expectations and the theory here of how expectations. I think obviously expectations are going to affect prices and they're going to affect asset prices immediately. But from the perspective of small businesses, at least, we've got a survey out with the Federal Reserve Bank of Boston, and we found, I think, somewhat surprisingly, but it looks like it's maybe corroborated here in the data, that they were going to take up to 2 years to fully pass through their expected cost increases onto consumers. In large part because of that uncertainty, so why pass something on if it's sitting in a ship off of the shore somewhere and it may not in fact be levied at the same rate that you expect. I think that's like the world that we live in. And also it doesn't pay to be the first one to raise prices. And so when you think about different competitive dynamics, businesses that don't want to be the one who are going to be the first to move. And we certainly saw that in the auto space. We saw a couple car companies actually cut prices over the last few weeks in anticipation of the rising tariffs because they were trying to gain market share. So there's a lot of sort of noise underneath the hood right now. And I think that's what we're seeing this month.
Yeah. Allison, do you think we're back in the realm of the plausibly innocuous here, right? Like you go back to early April, lots of doomer takes out there, and you could understand why. Like the market action had gotten pretty scary, but the policy has now moderated. It's not moderated completely. Like we have these 90-day reprieves and so forth. Nobody can really be certain where things are going, but it seems like we're moving in a direction of more and more moderation. That's what the news flow seems like. And here we're looking at the macro data, and it hasn't gotten terrible yet. Do you think that they managed to walk back from the brink sort of just on time here? Does it look like that to you?
They're very lucky they had such a resilient economy going in.
They did.
I mean, I always think of like, you have an economy and what brings it down is a shock. How much it's brought down, how resilient that is really how resilient is the economy going in. And they started with a pretty resilient economy with, very good American companies that are exceptionally innovative, and a bunch of other countries in the world that are a lot worse shape. I think they tried some experiment, and I think the whole global market really wants America to be a strong economy. So I think we're just believing the best. And, this ended up working out a lot better than it should have for them so far. I mean, again, we don't really know. And again, 10% tariffs, that's not nothing. I don't think it's going to bring down the economy or bring down the whole global economic order, but it's still nothing, not nothing.
Right. Absolutely. Before we go on here, I just want to walk through the decomposition and sort of figure out what's going on here. So this is, again, your decomposition of month-on-month seasonally adjusted headline inflation. And you have in the yellow, your contribution, excuse me, from core services. And so of the plus 0.2, excuse me, of the plus 0.2, the lion's share is coming from core services. We'll come back to that, but I did want to look first at core goods here. And the story here, surface level is subtle because, a contribution of 0.01 doesn't seem like very much, but, in the not so distant past, we were actually getting outright deflation from core goods. So what's going on here? Transportation commodities actually slightly deflationary on the month. New vehicles flat. Used cars and trucks down. I just want to caution: wouldn't take too much signal from the help that we got from used cars and trucks, because some of the leading indicators that we get from auctions suggest that used cars and trucks could actually be bouncing in some of the CPI reports that we get over the next few months. Okay, household furnishings. Again, you get sort of a very modestly positive contribution from household furnishings and supplies. That ain't nothing, because again, this is the kind of thing where in the past you might have expected it to be slightly deflationary, right? Apparel, though, stays in negative terrain. Recreation commodities, a little bit of a jump. I'll see if I can give you any further color there. Sporting goods contributing a bit. I think that's everything that I want to call out from core goods. So, like summary level stuff on core goods, some of these categories did swing from like modestly deflationary to modestly inflationary, but they didn't move the needle in this report in a big way. At the same time, you had a very modest contribution from energy, and you actually see a little bit of deflation from food. That ends up coming in large part from food at home. So let me just pause there. I do want to come back to core services because that's actually the biggest chunk of the ongoing inflation here. But let me just pause at food at home, since it is traditionally such a big contributor to the formation of household inflation expectations, and go over to you, John Lear, to talk about inflation expectations. Because if you listen to the Fed speak, the story continues to be that tariffs needn't necessarily be inflationary in sort of air quotes economists speak. Tariffs needn't necessarily be inflationary in and of themselves, even though we think they raise the price level. The real concern among voters on the Federal Open Market Committee is that inflation expectations may become de-anchored in this process, and that inflation could get back into the bones of the economy. Is that happening in any observable way in your data, John Lear?
It's not happening in our data, and I would say it's a big point of contention right now. We've got a weekly survey run with researchers from the Federal Reserve Bank of Cleveland, where we do something called indirect consumer inflation expectations. We ask people how much their incomes would have to change to make them equally well off, and they expect to change the price of goods and services they buy. It has shown, following Liberation Day, it did show a very modest increase in inflation expectations, but we didn't see that spike that you see in the University of Michigan data. One of those reasons is that spike in the University of Michigan data was largely along partisan lines. And I think that really has to do with how people are interpreting concepts like prices and inflation right now. It's become polarized. Whereas when you ask people about the price of goods and services that they particularly, that they buy, we haven't seen it. And so there hasn't yet been really a strong, compelling reason to see inflation expectations shoot higher. I would say similarly on the consumer sentiment front, we're seeing over the last couple of days a really strong rebound in consumer sentiment because trade policy looks to have some more, some certainty to it. Financial markets have some level of stability, and we continue to have this fairly robust economic growth, particularly on the jobs front. So I think there's really good reason to be optimistic, and I think you're going to see some of that optimism reflected in the sentiment data. Again, for really strong levels of sentiment and for anchored inflation expectations, you need prolonged periods of stability. So it's not over yet, and certainly a policy announcement or a curveball could change things. But through yesterday afternoon, the consumer looked pretty strong.
Right. And John, we were talking about sort of how much leash the administration sort of had here to launch this experiment. And Allison was saying they got a little bit lucky. It seems conceivable. Disagreeing with me if you'd like, but it seems conceivable that inflation expectations could continue to be pretty good here, even if things start to take a turn for the worse in like the core CPI, core PCE data, because I'm looking at the key elements that influence inflation expectation formation, right? Traditionally, we all know that consumers are very influenced by what they see at the supermarket. They're influenced by pump prices. We're seeing here in this report, food at home prices actually stepping down. We know from the price action in oil that there's some relief in pump prices in the pipeline. People are going to look in the newspaper, or I guess, does anybody read newspapers anymore? I don't know. People are going to, look on Apple News or hopefully Bloomberg.com, and they're going to see that the reported inflation statistics are pretty good. And all of this reverberates also across social media, which I know you've looked into how that affects.
I think that's the thing. I agree with your initial sort of scenario. I think the what's different now is that you could have one or two sort of outsized. You could have an outsized impact on inflation expectations from social media connections that are experiencing or at least resharing cases of elevated prices. And so you could imagine, something like the egg shortage being even more dramatic, taking up a larger share of the basket of goods. Gas prices may be localized somewhere. We just we didn't see that. There was an opportunity in April for a viral moment, so to speak, for, elevated prices, for everyone to share that around and that to become the narrative. That didn't happen. Right. And I think in large part that didn't happen because we just didn't, because businesses held off on raising prices, and they in fact didn't see elevated prices, right? They had inventories. There was some buffer in there preventing that immediate pass through.
Okay.
Do you think that everyone just sort of assumed we'd end up with a sane policy? And it was shocking. In December of last year, we ran the small business survey and we saw a very high share of small businesses expect to see some level of trade negotiation. Mm-hmm. The only instance where they expected protracted tariffs was on China. And so I think that is one reason actually to hyper focus on things like apparel and some of these other categories where the expectations and the reality are now aligned. And that's where I would start to expect to see a greater cost pass through. Again, you've got to get through inventories and there's other sort of reasons why it might not be immediate, but consumers and businesses expect tariffs on China to be here through the end of Trump's second term. Yeah, but I mean, I think one of the reasons markets just flipped out is I expected tariffs too. I was just reviewing what I was saying in January, but I didn't expect them to be so high as we saw on Liberation Day. That was just bananas. And then, if they really were that high and people were rational and forward looking, you would have expected big price increases. So I'm trying to grapple with, is it that people are not rational and forward looking and, I have to accept that? Or did they think, yeah, Trump's just a lot of bluster. In the end, we'll settle on something normal. And tariff rates are still high. Were they 30% now in China? Really high, but not crazy. I mean, kind of crazy, but not, we have to jack up prices immediately crazy.
I certainly think it's part of it is the latter. And I would say that was fueled as well from, from the perspective of businesses. It didn't pay for them to shut down their operations, to fire workers. There was demand out there. So they wanted to hold on. It was in their interest to hold on to workers, to continue to try to sell things to businesses and consumers. So it was a very, as you mentioned at the up front, Allison, I think it was a very positive time, if you can say that, to implement tariffs and to run this experiment without causing long-lasting damage, to have it sort of bleed over into the labor market and the other real part of economic activity.
Yeah, I did want to. Well, two quick things. I just want to make the point. I promised I would come back to the decomposition of services, and it's worth doing this exercise really quickly, because this is, we got a 0.2 on CPI, and it's basically all coming from core services. And I just wanted to show people real quickly, when you dig in here, it is again, one of these months where it's all about shelter, and like at the end of the day, I will, defer to, some of the CPI methodology ninjas that we all love reading, to hear whether or not we should trust this number. But like generally speaking, it feels like shelter continues to be a disinflationary force, or should. We get a little bit of a wonky jump in rent of shelter. My inclination for months and months and months has been to read these jumps as just a feature of the natural volatility of these numbers, and not get too worked up about it at all. In other words, if you were looking for another reason to be optimistic about this report, you could say, well, it was just shelter again. Of course, some people would would take the other side of that. It is it's sort of an inertial thing.
I think we've talked about that, John. I think we've talked about that every time I've been on this, or you've been discounting the shelter inflation now for the last. Maybe
I have, but here's my argument. Look at the trajectory, John. It's been down. Like in the month-on-month figures, it bounces around a lot, but on a year-over-year basis, it's been pretty clearly a downward trajectory for 2 or 3 years, right? So that's
yeah, but it's still, what you're looking at is contributions to the CPI, right? So that still is, those are still increases.
That's fair, but here it is as just a year-over-year change. So given what we know about this, given that it's inertial, I feel pretty good about this.
I know we're looking at shelter and core services here. Shelter has come down, but I do think we live in a world where there's a limited supply and we have a housing crisis. And I think that's going to be here for the foreseeable future. I don't think I don't see any sort of near-term change to that structural feature of the U.S. economy. So it's coming down from crazy highs, but I would expect to see shelter continue to be sort of a positive, and I don't want to say a positive force, but it will shelter. I don't think shelter prices themselves are going to come down.
Right.
Yeah. Granted, New York is a weird market and not representative of the rest of the country, but it does have a vigorous rental market, I guess. So that, that's an interesting data point. And it does seem like a year or two ago, rents were going up like 10% a month, like obscene. But they're still really high and going up, but just at a normal New York rate now.
Right.
Which is still high, but not like if you don't sign your lease now, they could rent it to someone else for 20% more tomorrow.
Yeah. Well, let me try and find the middle ground and say, I'm a Florida man, right? And as everybody knows, the housing market feels a lot different if you're in Florida right now. Florida is actually seeing year over year drops in housing prices. Part of it has to do with idiosyncratic features around condo legislation, I think, but there's been a big buildup in inventories in recent months, and I think people are reasonably asking themselves, is Florida a sign of what is to come elsewhere in the country, or is it a leading indicator, or is it totally idiosyncratic? And I think I think that's not 100% clear to me. I do lean more towards idiosyncratic, but at least that tells you why I have a very different take on housing than I think you do, John.
Yeah, I always think of Florida as both a leading indicator and idiosyncratic, in that it is leading, but it also is more volatile, more extreme than anywhere else.
Yeah.
So
Well,
take whatever happens in Florida is coming to you by a third.
right. It's a high beta market. That's for sure. Let me just bring us back big picture here in our last 5 minutes, though. And I just want to frame the last 5 minutes in terms of the question of uncertainty, and interpret that however you'd like. It's uncertainty for businesses. It's uncertainty for consumers. Because Allison, you wrote a great piece maybe a couple weeks ago. Ernie Tedeschi writing for us also had a take about how the tariff agenda in and of itself might not necessarily, or needn't not necessarily be recessionary, right? The tariffs as we understood them at the time, which were actually a lot worse than what we're dealing with today, could have been a force for slower growth. But arithmetically, you plug them into the model, they didn't have to cause a recession. And you could say that some of the hand wringing was overdone. But the big question, as I understood it, was always this issue of uncertainty. You could say, okay, you plug these numbers into the model, not too bad, right? Trade isn't a huge part of the U.S. economy. Maybe it's a quarter of GDP, something like that. But the uncertainty that you introduce for economic actors is this whole other thing. Very hard to predict how that was going to play out in a world in which nobody really knows what the tariff rate is going to be. It seems like we kind of have a little bit more certainty now. So is the bear case based on uncertainty fading in your mind, John Lear?
Yeah, definitely. I think it has been fading, I would say, for the last couple of weeks. I mean, what we saw early on with reciprocal tariffs obviously had people freaking out, again, because of the direct impact of elevated tariffs and prices, but also the uncertainty. And you could go hear it anecdotally from businesses talking about concerns around making investments. But what they didn't do is they didn't fire workers. And I think that is really the critical element here, is that we continue to have a world where businesses talked about reducing investment. They talked about investment uncertainty. They kept workers on their payrolls. That fueled the financing and the cash flows that consumers needed to make those purchases. And that kind of kept things going. We kicked the can down the road and lived another day, and we can recover from that. It didn't have to be that way, for the record, right? I mean, we talk about it now. 6 weeks ago, it could have played out very, very differently, where you had such elevated levels of uncertainty that, in fact, businesses reduced future investment and current investment by cutting payrolls. And so I think we're very fortunate in that sense. And I've seen for the last few weeks strong signs that the U.S. will kind of muddle through this year with elevated tariffs, but not crippling tariffs as we had expected.
But was hiring down? Like, I would expect them not to fire workers under uncertainty, because especially after the pandemic, where it was so hard to find workers. Or, so the question is, did the uncertainty reduce hiring? Did it reduce capital investment? I don't know, but I guess that would be extreme uncertainty means you might fire someone because it's going to show up in your bottom line with people buying less. But it didn't go that far, but did it go far in other ways?
I mean, there was this weird disconnect where the future looked really terrible, but the present was okay.
Mhm.
And I think, you were talking earlier about the rationality of businesses or consumers. That's a challenging situation to try to figure out how to sort of optimize. Because if you just say, well, it's hopeless, let me shut down operations, you're leaving a lot of money out on the table. And for public companies, I don't think that's doing right by shareholders. And so you've got to find some way to simultaneously sell in the near term, and then also to be concerned about some of those longer term investments. But now I think you can very reasonably expect to see business investment pick up. We have, 30% is not great, but it's not terrible. And I think we have a basic sense of what the world is going to look like for the next few years. It seems to me that companies reasonably should be going out there and trying to, update their strategies and go execute.
All right. Well, let's leave it right there. Just to round up, your CPI month on month in the United States of America actually comes in at plus 0.2% month on month. The core was also 0.2%, and your headline year on year 2.3%. Not too bad. Not too bad. I want to thank John Lear, Chief Economist at Morning Consult, Allison Schrager, my colleague at Bloomberg Opinion, and thank you to everybody for tuning in. Have a great week.